So today we are going to be talking about the cycle in the stock market. We're going to be talking about the stages or phases that you go through in the stock market. So in this video, I will explain the cycle of the stock market, that is the 4 phases in the stock market, and the emotions attached to each phase. I will also let you know how to handle each phase and give you examples of each phase that had happened in the past. Market cycles are the natural repeating patterns of the expansion and contraction that occur in the stock market and the broader economy. Understanding these phases can help investors manage risk and identify opportunities, though their duration is unpredictable. The stock market cycle has 4 main phases. Each phase reflects different stages of price action and investors' emotions. So we'll start with the first phase, which is the distribution stage. This is also known as market boom. This is the bullish cycle. Here, the smart money who likely bought earlier start selling their positions because they are sitting on high profits already. They are cautious about the fate of the market. This is when the hype is in the atmosphere and everybody is rushing into the stock market. This stage may often take a while as the market forms a topping pattern like the M pattern or head and shoulder pattern. The distribution stage usually starts with investors' emotion like euphoria or thrill, where leverage margin and speculation are at its peak. Since many late investors still have the mindset of buying the dip, further sell-off brings the price down and some investors buy the dip. The buyers fight back and maintains the momentum for a while. When the price recovers, investors become complacent as prices stall and volatility cools off. So we shall take a look at the S&P 500 from 2007 to 2008 that the market was at its peak.
So on the chart, you can see that pattern that was formed, like an M pattern, or you can call it a head and shoulder pattern. You can see how I drew it on the chart. This pattern describes a situation whereby people are very complacent. There's euphoria in the market, in which everybody is just coming into the market using leverage margin, and everybody is feeling like the market is always going to remain at its peak because this is the top of the bull market. So people have so much feelings attached to the market right now that the market has done how many X and it will just keep on going higher and higher. So when it forms that M shape, right, it shows that a lot of smart investors have sold a little bit, then some other investors bought as the price was coming down to support the price of the S&P 500. So when it makes that second top, there is not much liquidity in the market, or there's not much buyers or investors in the market to see the price go higher than that. So it just maintains that height. As people start to take profit, it kept going down gradually until it just plummets down. So the distribution stage usually starts with investor emotions like euphoria, complacency, people believing that nothing can go wrong with the market at this point in time. The hype is so much in the market.
So we shall look at how to invest during this stage of the market. So at the distribution stage, if you are already in profits on some of your stocks, it is best to sell off most of your positions. If you still have some cash, consider not entering back into the market for a long time at that. You may also look at other assets that is at its accumulation stage. That is, you can look at another industry or another asset class, but not the stock market. Number 2, we look at the markdown stage. So this cycle is also called the panic stage. Here, price begins to drop as selling pressure rises. Investor sentiment turns negative, leading to more selling and so on. This causes the price chart to trend downward with lower lows and lower highs. This stage continues until excess leverages and speculations are flushed out of the market and prices begins to bottom out again. That is, until the next accumulation stage. The markdown stage could be due to recession, market sentiment, geopolitical tension, political instability, or economic meltdown. All of
I
this leads
agree,
to
but how do
fear
we measure that
in the
impact
market.
effectively?
Therefore, investors end up selling their shares out of fear and panic. So the investor's emotion displayed in this particular phase is anxiety as the dip turns into something worse. Then comes denial as prices keeps dropping further, which eventually turns into panic. The markdown phase often ends in capitulation as investors give up and sell their shares in losses and they become enraged with anger. So in this phase, we shall cite an example of Bitcoin and look at how Bitcoin slided down between 2021 to 2022. You can see that it was trading for about 67,000 US dollars. Less than a year, it marked down to 29,000 US dollars. So this is an example of how the markdown plays out in the market.
So the investor's emotion in this particular stage is anxiety. It is just you watching your asset value reduce day by day or week in, week out. So you start being uneasy. We have anxiety as a dip keep turning into something worse. Because you might say, oh, okay, the price might recover tomorrow. The price might recover next tomorrow. Unfortunately, it doesn't. You still keep seeing lower lows, lower lows. So it gives anxiety and frustration to investors.
So someone might ask, hey, how would somebody invest in this phase of the market? When prices keeps on dipping, the temptation is to buy the dip. But what happens when the dip keeps on dipping? Instead of trying to catch a falling knife, it is better to completely steer clear from the market until you see a clear sign or signal that the accumulation stage has commenced. If you can relate to any of this and you are getting value from this video, please hit that subscribe button now and don't forget to like and share this video with that person you know that needs to see this. So now let's get back to the video. So number 3 phase is the accumulation stage. So the accumulation stage is the bottom stage. This happens as the market bottoms out and smart money investors start buying or accumulating investments at lower prices. That is, they are just getting all of their favorite stock at a discounted rate. Market sentiment is mostly negative here, but prices begins to trade sideways as the downtrend loses steam. This stage can last for several months or even years. This is after weak hands have been completely shaken off of the market. That is, the bottom is already hit and price starts going sideways for a bit, setting the pace for accumulation and uptrend. You have to notice in the chart how the price makes slightly lower lows while the relative strength index makes slightly higher lows. This will trigger bullish divergence. That is a sign that buying pressure was getting stronger and accumulation was on the way. In the markdown phase, anger and depression is the emotion of the game. According to an investing legend, the time of maximum pessimism is the best time to buy your stocks. That is, when everybody have given up in the stock market, when the prices keeps dipping down, that is the time to narrow cost average into the stock market. So we shall cite an example of gold between 2014 to 2019. That is about 5 years of the market moving sideways.
So gold had such long accumulation stage. So the market emotion in this stage is maximum pessimism because everybody is afraid of, oh, since the market has gone so low, what if I put my money inside this market? What if I put my money in this asset? Will they keep going lower? So that's where the fear is the highest. A lot of people will be reluctant to want to come into the market, even though they are getting a very discounted rate for this particular asset. but they will still be fearful, and they would want to wait until they see that the price has gone up to a reasonable level. This accumulation stage for gold from 2014 to 2019, we saw the price just ranging from $100 to about $142. In 5 years, you can see how boring this could be. You can see how frustrating this could be, just seeing the price go up, go down, go up, go down. No massive uptrend, no massive shoot up in the price of this commodity.
So you might ask me, so how do I invest in this stage of the market? You have to buy at a discounted price. Here, you will need to naira cost average into the market because the phase can last for a long time. Nobody knows how long this phase would last for. So you have to consistently buy at different levels to average out your purchases. So look at the last phase, which is the markup stage. This is also known as the recovery phase. It follows accumulation and involves rising prices and increasing investors' interest. The price chart makes higher highs and higher lows, forming an uptrend. At this stage, investors and institutions step in and start scooping shares in the market. Then the market starts getting healthy again. Investors' emotions in this phase tends to start with disbelief. Then they start having some hope for possible recovery. Next comes optimism and belief as the market booms higher and investors get fully invested.
Look at an example in the chart for the markup stage. We'll be looking at the NGX 30 index. This is the top 30 companies in the Nigerian Stock Exchange. We're looking at 2025 precisely. In 2025, we saw a very good bullish rally on the NGX market. We saw the price going from 3,800 naira up until about 5,600 naira, almost a 2x price range we saw for just 1 year, right? So you can see the value of this market really went up. So the investors' emotion in this phase is usually disbelief. They be like, oh, what's going on? That the price in this market seems to be going up and up and up. So they'll be in disbelief. So next comes optimism and belief as the market booms higher. That would see the market keep going up and up and up. That would be like a massive uptrend in the market. A lot of people will chiming in into the market to want to get a piece of the cake that the market is dishing out.
One might ask, so how do I invest in this stage of the market? So at this stage, you typically want to hold on to your investments and avoid selling your positions too early. The trend is your friend. After all, you should consider monitoring moving averages to gauge whether the uptrend is still your friend till the end. So these are the 4 phases in the market. It's a cycle of the stock market. That is how the cycle continues. But how long does each of the phase last for? No one knows. So the 13 emotions in the market cycle is you have hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, capitulation, anger, depression. So all of these emotions are experienced at one point in time or the other in the stock market. So my opinion is that the market is designed to extract money from emotional investors. The key is not to invest based on emotions. I want to thank you for sticking with me right through to the end of this video. And I want to trust that you've learned something, you've gotten valuable information from this video. I want to urge you to kindly subscribe to the channel, like this video, share this video with your friends that have been hearing about the stock market and don't have very much information concerning it.